Now, please allow me to introduce our first speaker for today, Mr. David Ng. So David is currently a full-time proprietary trader with Iceberg X. He has done extensive research and is well-versed in the commodities and indices market. He also provides frequent market commentaries to local media. So our audience, are you all ready? Now I'm going to pass it over to David.
That's good enough. Thank you, Ting Ting, for firstly the introduction, and obviously thank you for inviting me. So just before I start, just like to thank Excellent as well as Bursa Malaysia Derivatives, and as well as the broker RHB, for inviting me today to speak on this platform. The burden of speaking the last webinar, before heading to the derivatives trading challenge is indeed a very tough or high responsibility for me. Obviously, you should be going to the trading challenge with enough knowledge, with sufficient knowledge in order for you to be able to navigate the market, be it whether you are using fundamental or technical. But I think it's crucial for you to have a bit of knowledge, as you prepare yourself for the trading challenge. Fortunate enough for the audience here today. I think when I started the market, there was no such thing as a trading challenge, or perhaps that idea was not known before. But I think, when you navigate in the futures market, it's always important for you to get a bit of knowledge. And I think the exchange itself, together with the broker and the education provider, they are very kind enough to be having such a platform for the audience to actually learn and navigate the market through the proper knowledge. So just before I start, as usual, risk disclaimer. I think anything that I mentioned here today in this education webinar is purely based for educational purpose. So any opinion is purely on my own. It doesn't reflect the opinion by the broker or by the exchange. And like I mentioned, dealing with futures does involve a lot of risk. And always good to start off by using simulation. And I think this derivatives trading challenge is going to be a great platform if you're someone new to the futures market and you want to try your hands on the futures market. I think there's no other better way than to involve yourself in this derivative virtual trading challenge. In fact, you got prize money to be won. So I think that's definitely a win-win situation. So do get yourself equip yourself with sufficient knowledge before you engage in any of the derivatives product. So in the next an hour session or so, this is what I'm going to cover. I think the topic today is talking about Heiken Ashi. When I started this industry, I started as a fundamental trader. I look at news, I look at reports, I look at analysts, I analyze data and whatnot. But as we go through, as being a full-time trader, the just relying on fundamental itself is not going to help much. And I think in a way we really need in a sense technical tools for you to actually be showing you the exact entry and exit level accordingly. And I think one of the great tool that I frequently use is always the Heiken Ashi. I know the name sounds a bit weird, but that's how it is. It's also part of Japanese candlesticks, which I'm going to touch on later on. But if you are someone that's trading the market, there's always two types of traders that's outside in the market. Are you trading? You could be a trend trader, or you could be someone that's trading on different type of indicators. But I always have this philosophy. When I first started, it's always good to be trading with a trend, because in the market is trending, it's always showing you the point of least resistance. If you are finding ways for you to pinpoint the market tops and bottoms, it's always very difficult because it's never easy. So always, when I do educational talks, I always engage the audience is that trade with the trend. If the trend is going upwards, find opportunities for you to long the market instead of finding opportunities for you to short the market. Because when you trade in favor of the trend, normally that's where you get a lot of opportunity. But if you're trading against a trend, it's always a very difficult business to do because sometimes you do get a lot of whipsaws along the way. So I think, if you are a trend trader, Heiken Ashi is a very good tool, technical tool that you can use, especially to identify trends in the market. So obviously, when you talk about Heiken Ashi, it's actually part of Japanese candlesticks. There's a lot of pros and cons of using Japanese candlesticks, and as well as there's pros and cons using Heiken Ashi, which I'm going to touch a little bit on, later part. And obviously, we try to apply Heiken Ashi into current dynamics. So looking at some examples of how we can actually look at Heiken Ashi candles, when looking at whether it's in the CPO market or whether in the FKLI index futures market. I think either way, Heiken Ashi shows you the trend, regardless of any market that you're trading. If it does give you a signal for you to be positioned in the market, and that's where you should be taking position. Last but not least, I think a perfect trading plan always comes with a risk management tool as well. So I'm just going to share a little bit on how the way I manage risk accordingly, using also technical tools, because it's there's it's always easy to find positions for you to enter, but getting out, whether it's a profit or loss, is also equally difficult. So I think that's very critical for us to understand that when you create a trading plan, you must incorporate measures for you to get out of the market, which means your stop loss management. So I'm just going to touch a little bit on fundamentals, because I know that given that the insights today is mainly on technical, but I believe that whatever we see in prices, be it whether the uptrend you're seeing right now in the CPO market, is it going to last, and what's the reason behind this justification of the recent rally. I believe there's a lot of factors that actually can be attributed to fundamentals, and I believe fundamentals can play a quite crucial role if you look at whenever you look at trend trading. So I think it's important for us to recognize as well as acknowledge that fundamentals do play a role. And as much as we hate to read reports, to analyze data, but I think these are all crucial because when you are trading the market, all this will actually aids you in developing your conviction whether is the current rally is going to sustain, or fundamentals doesn't tell you a rosy picture going forward. So therefore, I think technical will also start to show. So I think interplay between fundamentals and technicals, or incorporating both together, does give you a bit of edge when it comes to really looking into the market. So I'm not going to touch much on FKLI today. I think given the limitation of time as well, so I'm just going to focus on CPO, palm oil, I think, which is a very volatile market, as we have seen. So you have noticed prices as actually trading all-time high this year. I think it hit as high as 8,000 ringgit per ton, but after that it adjusted pretty downwards until as low as 3,000 ringgit in a short span of 6 months. So I can tell you it's a very volatile market. And if you don't get it, I mean, if you don't measure a stop loss well, or you don't ride on the proper trend, I think that's where you can get caught easily. So just let's look at some of the fundamentals. I think the key thing we have to look at is basically, what are we seeing right now in the market? Now, if you trade palm oil as a commodity, or be any other commodity in general, the reason I like to trade commodities is because there's always season, there's a pattern, historical pattern. Now, if you just look at this is fundamental data. You can get all this from MPOB, and if you just look at the chart itself, you can clearly see these are our production data, and you break it month to month, you notice one clear pattern that's emerging. If you just look at production pattern in palm oil, it usually tends to peak around October, November. And once we enter into the last couple of months of the year, that's where you start to see production starts to come down. And normally, if you just go basic economics 101, if supplies is coming down and assuming demand is constant, what happens to your price? It's most likely it's going to go higher. So that's where we see a so-called historical pattern that we can see in CPO market. Now, having said that, these are all historical. Whether history will repeat itself, that's another different story. But what is crucial to take note is that production pattern is showing you that it's going to peak. So likely prices is going to be supported as we head towards the year end. Now, if you are trading CPO market, fundamentally, we have to recognize and we have to acknowledge the fact that, if supplies are rising, stock levels usually is are quite a very important barometer for us to gauge where prices will go. For example, if stock levels are high, normally you don't expect prices to stay high. You just look at this comparison of chart that I have here. You look at the stock levels, palm oil stock levels in the country, and if you compare with CPO prices, you notice that one thing is quite clear. When you have high stock level, when I say high, it could be more than 2 million to 3 million level. You notice that prices of CPO cannot go up. But once the stock levels start to diminish, that's what we have seen in 2021, where stock levels actually fall below 2 million ton. That's where market panic, and you can clearly see prices start to rise tremendously. So this is I would say, a relationship that we can clearly observe. Again, it's historical. So what we can clearly observe is that, based on historical basis, whenever high stock levels in the country, that normally will not be good for CPO prices. So where we are right now, you can clearly see that CPO prices are indeed coming down because stock levels are actually going higher. So this is one relationship that, if you are trading the palm oil market, we have to take note and acknowledge. And one thing good is that we have consistency of data if you want to analyze. So every month we have official numbers from MPOB, which tells you whether production is going up or coming down, or stock levels are going up or down. Now, so going back into demand is again, I think, slightly on a bit on negative side so far this year. So I think all the fundamental factors are stacking against palm oil at this point in time. If you just look at performance of export in Malaysia, particular, I think this year so far has not been very rosy. And I think we just only left 2 months throughout the whole year. I think export this year on year is going to be weaker. Now there's a lot of reasons to it. I'm not going to go too detailed on that, but again, I think you can clearly see on the limelight, global economy is heading into a slowdown and whatnot. I think all these are actually impacting the demand for palm. Same goes for Indonesia. The reason I post Indonesia here is because Indonesia is actually a very big market for CPO. If you are trading a palm oil market, I know Malaysia data is important, but Indonesia is also equally very important because they are the largest producer in the world. So therefore, pretty much whatever they do, policies, action against done by the government will have an impact in terms of prices at the end of the day. So that's very brief introduction to, or rather, a review of where the fundamentals of palm oil is right now. So you can clearly see that we're heading towards the last 2 months of the year, where normally, based on historical basis, we start to see production pattern tend to come down, and that's where prices tend to be supported. So I think that's important for us to take note. So in terms of trend, the reason really they are seeing in the market is possible we could see some support because historically we are going into lower production period, and as well as stock levels probably may moderate or in fact come down in the next couple of weeks or months. So I think going into the main gist, it's important for us, once we identify the key factors that determine the palm oil prices in terms of fundamentals. Now, next is always to find a right price for us to be entering and exiting the market. And to do that, we can always look at using technicals as a tool for us to use whenever we want to navigate the market. And I think one of the great tools is Heiken Ashi. Now, I think I don't go too detailed on trading plan, but it's important for every new trader. In fact, every trader should have a trading plan. The trading plan could consist of whether you are trend trading strategies or whether you are sideways trading market strategies. It doesn't matter, but as long as you must have a plan when it comes into trading the market. Now, first thing is always if you are a trend trader, is to identify the major trend of the market. So that's your main goal for a trend trader. So there's a lot of ways to identify trend in the market. One of the ways is to look at it visually. For example, if you see prices having a higher high and higher lows, that generally tells you it's an uptrend market. So that's visual. And lower highs, lower low, that's normally a downtrend market. And you can't differentiate between the highs of each other. That normally tells you are actually in a range market. So trend is important. The particular trend at that point in time is important for you to gauge, because if you're in an uptrend, like I said, if you are trading with the trend, you should be finding opportunity for you to long the market. And if it's a downtrend, you should be finding opportunities for you to short the market. Sideways is going to get a bit tricky. So that's where you really need to have to identify the support and resistance area in terms of prices, and that's where you should be doing your long and short positions. But having said that, trend is the first thing you need to do is identify the trend if you're a trend trader. Now, second thing is, trend will not, the strength of the trend is equally very important. The uptrend doesn't always last. The downtrend also doesn't always last. There'll be a point in time where trends tend to be a bit more lack in power or exhausted. And once you identify the strength and you are able to capitalize on it, I think that's going to be a very good opportunity for you to be, in the market. So for example, if you are, riding the trend upwards on an uptrend basis, you bound to be a time where strength of the uptrend is going to be weak. And if you have technical tools that can help you to identify when the particular strength of the trend is getting weaker, then if you're holding a long position, that's a good time for you to be exiting the market. So gauging the strength of the trend is also very important. And I think third thing is going into the intraday or daily basis. How are you going to position your entry and exit? I think one of the good ways is to look at Heiken Ashi. Obviously, there's a lot of other ways that you can use, but I think the focus here on tonight's conversation is mainly on Heiken Ashi. Now, having said that, obviously, if you have been trading the market or you already have been involved in the market and you have already pre-existing strategy that you are using and it's working, by all means stick to it, because when it comes to trading, whatever gives you money, I think you should keep using that particular strategy until you have exhausted the profitability of that strategy. Anyway, but I think it's good for you, good for the audience as well, to really look at other different set of strategies that you can employ, especially when you talk about trend trading. Now, having Heiken Ashi itself may not be sufficient. Obviously, if you want to make it better, you can incorporate moving averages, which I'm going to touch later part as well. And last but not least, like I mentioned, in every trading plan, always important to have a plan for you to exit the market or to stop loss, just in case the strategy doesn't work, the market go against you, you're out of the market. Now, if you just look at how prices this year in CPO market has been, you are very fortunate to to be out of the market if the market goes against you, because when the market go against you, it can go against you very aggressively and rapidly. So that's why it's important for you to make sure that you must have a stop loss management in place, because without a proper stop loss, you're just putting yourself to too much of a risk, especially in this type of market. Now, so process in setting up your trades. Now, just these are all some of the clear examples that you can use. I think first thing is always identify the markets that you have that you are comfortable with. I use the word comfortable because when a lot of people start trading, they always want to go whether it's peer reference, or just because your friends say that, oh, this market is good to trade, you're just going to follow a friend, but without doing a proper research. Again, I think at the end of the day, trading is very individual. So it depends on how the characteristic of the particular trader. If you like a high volatility market, because that's your nature, you can bear more risk, by all means trade those markets. But if you're someone that's looking for a bit more conservative, then again, look for more the nature of the product or nature of the market is less volatile. I think that suits to more conservative profile. So again, I think market is important. I think that's the first thing you need to identify, which market is suitable for you. So I think that's usually a crucial step. Position sizing. Now, if you look at in many if you have read some of the trading books, a lot of traders, successful traders, they always emphasize position sizing. And I do recognize that position sizing itself is actually a technique or even a skill. And I think it's just too much to be to be touching on it on a very in-depth basis. But if you have the time, really go through methods of position sizing, especially once you have reached a level of consistency in terms of strategy. Once the strategy has given you that kind of confidence level, and I think it's time for you to be actually upskill your trading level by looking at position sizing, because I think position sizing itself is another element that can actually help you in terms of your trading. Entries, obviously that will be your signals. Like I mentioned here, will be Heiken Ashi. So looking at position where you can enter and exit the market. Stops, these are all very crucial in terms of risk management. And obviously tactics. Now, in a lot of trading strategy, they always emphasize, oh, what's the success rate? Obviously, success rate is equally important, but equally more important is how you manage your risk. Because you can have a series of losses, but if you keep your losses minimal and you keep your wins in a much bigger magnitude, ultimately you still can be a net gainer in the market. So that's why it's important for us to make sure that when we want to manage risk, that will be the key thing we look at when it comes to trading. And in fact, that will be the most important thing we always focus at when it comes to trading. So I'm just going to show you this chart. You can clearly see that palm oil itself this year has actually been a very volatile year. I think if you just look at how the performance it is, you can clearly see that prices went as high as 8,000 ringgit per ton. Then it couldn't reach there. Then it went all the way down to 3,000 ringgit where we are right now. And obviously, this past couple of days we have seen strength in the market because there's news coming in, fundamental bullish news that's coming to the market, which is actually helping the market to stay above the 4,000 ringgit mark. Now, if you want to look at where the trend is, overall trend of the market, just simple plotting a 200 period EMA can give you a bit of indication where the CPO market is. If you just look at it, I think if you just look at a 200 period EMA comparison, it still looks like the market is trading below the 200 period EMA, which usually signifies that the market is still on a downtrend basis. Again, I think this is all the longer term picture for the market itself. And that's where it's important for us to look at. If you are someone that's trading on a shorter time frame, look at it, look at the trends on the shorter time frame. But if you're someone that's trading on a longer term time frame, 200 period EMA can give you a gauge, and it just tells you that the market is indeed trading below the 200 period EMA, which points to you is still on a downtrend basis for the general market. Now, FKLI is again very similar picture. In fact, I think FKLI is still trading below the 200 period EMA since I think pretty much of the whole of last year and this year as well. So it goes to tell you that FKLI market is generally quite weak. And if you just look at where 200 period EMA is resting, it's actually resting on a 1500 1500 mark, which is a psychological level. So as long as prices are trading below a 1500 mark, generally the FKLI is still on a downtrend basis based on the 200 period EMA. Now, this is just showing you palm oil into gas oil. I think this is just to someone, if you're looking at spread, I think generally people look at palm oil comparing it crude oil. And I think that's because, there's a bit of relationship in between both these products. Normally when crude oil is strong, palm oil will also be strong. So again, we just look at technical basis. This particular spread has actually been riding very positively. So what you can deduce from here is very simple. I think what we are seeing right now, palm oil is relatively very cheap. And as long as crude oil stays where it is, probably about 100 US dollar per barrel, or anything below or anything above 60 or 70 US dollar per barrel, there's a lot of incentive for people to actually blend palm oil with diesel. But again, it's funny that sometimes when you see spread like that widen, but again, palm oil still can remain quite negatively. I think that's something that we really have to look at. Now, so going to the chart itself, the technicalities. Now, if I'm just going to show you these two exhibit here, exhibit A and exhibit B, and I'm just going to ask you, which is a particular chart that can tell you a trend of market, which exhibit will you be choosing in terms of looking at where the trend of market is in a much clearer manner? Will it be exhibit A or exhibit B? Yeah, I can see those responses coming in. Yeah. So just to give the audience, just to let the audience know. So a lot of people choose exhibit B is because if you just look at exhibit A, which is your normal Japanese candlesticks, and exhibit B is your Heiken Ashi. Now, the comparison between A and B is that when it comes to trend, it's very clear that we can clearly see, Heiken Ashi actually points to you the trend at a particular point in time in a clearer manner. Japanese candlesticks, it gives you a lot of false signals. But when it comes to gaps, Japanese candlesticks shows you the gap. Heiken Ashi doesn't show you the gap because it's a calculation based on the Japanese candlesticks. So in a way, if you are a gap trader, you trade based on gaps, Heiken Ashi may not be beneficial for you because it won't show you the gaps. In fact, it will actually reflect the gap with the candle colors as well. So I think that's where you really need to distinguish yourself when it comes to trading Japanese candlesticks and Heiken Ashi. But in general trend trading, I think Heiken Ashi does give you a bit of clear indication where the market is heading at that point in time. So how Heiken Ashi is calculated, I'm not going to go too deep on the maths. You can probably go Google it. Again, it's all simple mathematics. It's basically taking the middle middle calculation of a normal Japanese candlesticks. That's why if it shows you the trend in clearer manner, and it also takes out the gap. So in a sense that if you are someone that try to visualize where the trend of market is, I think Heiken Ashi can be a very good indication at that particular point in time. So this is a sample of Heiken Ashi calculation. You can obviously look at a slide. And with the modern technology nowadays, I think most of the charting software already incorporate Heiken Ashi as part of their technical platform. So in a way, it's also easier for you to assess Heiken Ashi, not like those days when, before the advancement of technology, it's always very difficult for you to assess Heiken Ashi. In fact, you have to calculate it yourself. I think now with the advancement of technology, it's just a simple click of the button and you can clearly see once you look at the Heiken Ashi charts, you can actually make your decision much faster. Now, the difference between Heiken Ashi and Japan's candlesticks is, first thing is the gap. Second thing is, a lot of people like to use Heiken Ashi in the sense that for trend trading is because Japan's candlesticks, if you really go into in-depth study into Japan's candlesticks, it's very tedious in the sense that, there's a lot of configuration that you really have to recognize. Whether it's doji, bullish harami, bearish harami, and whatnot. There's a lot. I think it's over more than 100, configurations that you can have. And that's where, if you are someone new to the market, it tends to get a bit more, it will definitely drain you. And that's why Heiken Ashi, in a sense, is very well accepted because it gives you the kind of, good indication of where the current market trend is likely to go as compared to Heiken Ashi. And obviously, Japan's candlesticks, if you look at some of the configurations, is actually trying to identify more of reversal patterns. So you're trying to be a contrarian trader rather than a trend trader. So if you are someone that's trading with a trend, riding with a trend, I think Heiken Ashi will suit that kind of profile better. And Heiken Ashi, it only matters about the color. So as long as you see green colors, green candle bars, that tells you the market is on the uptrend. If it's red colored candle bars, that generally tells you the market is on the downtrend. So it's as easy as that. Japanese candlesticks is very, they are very focused on pattern. Once if you don't see the kind of pattern, that means, pretty much, you really have to recognize that pattern. So it comes to experience, and you have to look at many series of candlesticks charts in order for you to perform or to perfect the skill even better for Japanese candlesticks. Now, so just to show you, I think just to give a clearer illustration of the Japanese candlesticks and Heiken Ashi, so you can clearly see where, if you just look at Japan's candlesticks, which is the bottom panel, you can see that there's a lot of series of red and green candles. And that's where it tend to confuse you because at that point in time, you're not sure of the particular trend. Are you in a downtrend or are you in an uptrend or you're in a sideways market? But if you are using Heiken Ashi, it very clearly states that, those tiny little green and red candles, they'll be not reflected. You just reflected in a downtrend basis in a red candle. So in a way, you're keeping yourself longer in a particular trend, and you don't get exit out as quickly as compared to Japan's candlesticks. So I think that's one of the key benefits of using Heiken Ashi as compared to Japan's candlesticks. So these are the three things you need to know when it comes to Heiken Ashi. So it's not like Japan's candlesticks, you need to know 100 over different styles. When it comes to Heiken Ashi, you just need to know only 3 type of patterns. The first one is basically like a whether it's red bar or green bar, as long as you have a wick, a small little tiny line on top of the candle or below the candle, that generally tells you the strength of the trend is getting weaker. Now, if it's just only a single line for, let's say, a green bar, which is the top, there's only a single line at the top bar for a green candle, and a single line for a red candle, that generally tells you the market is actually very strong when it comes to trend. And if it's a green candle, that means the uptrend that's gaining momentum. If it's a red bar, that tells you generally the downtrend is gaining momentum. So it's easier for you to identify whether the momentum or trend is still intact or whether you are actually approaching a weakening trend. Like I mentioned in the beginning, if you are in an uptrend, if you see green candle bars, we have upper and lower single lines or wicks, we call it. That generally tells you that generally the market is the trend or the strength of the market is going to get weaker, and that's where you should be exiting your position. Now, if the body of the candle is very thin, that generally tells you there's actually no trend in place and it's actually a sideways market. So during that time, you should be using different type of strategy for you to navigate the market. So now interpreting, I think, is as easy as that by looking at the color of the candles. So as long as you see green colored bodies, that generally tells you it's going to be an uptrend. Red color bodies, that generally tells you it's going to be a downtrend. And if the body is very small and the lines are wide, your wicks are long, that generally tells you the market is actually on a sideways market. So just to give an indication, so you can clearly see, during this part, we do have parts where the series of candles are very small, the body of the candles are very small. That generally tells you are in a sideways market. And during that time, it's best for you to employ a different style of strategy during a sideways market, which is fits for a sideways market trading strategy. As what I mentioned today, I think Heiken Ashi is more towards a trend. So you should be looking at candles which have a long body candle. So like this part here in this chart, we see a very strong red color body bar. That generally tells you it's going to be a strong downtrend. So during this time is a very good time for you to position your entry accordingly. Now this is another classic example on KLCI. I think it's quite illustrious example. If you just look at FKLI based on a Heiken Ashi configuration, you can clearly see that there's a very nice red color candle bars developed early in the stage of the downtrend, and it stayed there until there's a series of red and green candles starts to appear. That tells you generally the downtrend is starting to be exhausted, and that will be a good time for you to either exit the market. But then again, a long series red candle bars starting appeared. Again, that tells you the market is still on a weakness basis. But however, I think towards the end, we start to see strong green colored candle bars. That generally tells you the market is actually going to change trend and slightly going to move on the uptrend. So just looking at Heiken Ashi is very clear as how you can identify whether the trend of market right now is downtrend or uptrend just by looking at the color of the candle bars. In a way, it's actually helping you to manage yourself and keeping yourself in a trend on a more longer term basis as compared to just looking at Japan's candlesticks. Sometimes you do get exited pretty early in the trend, and that's where you lost a lot of opportunity. Now, palm oil, I think, is another similar great example. You can clearly see, the color bars formations are very clear. When you have red candle bars, that generally tells you it's on a downtrend basis. So I think CPO itself is actually very nice downtrend towards beginning of September onwards. So I think that's where it's useful for us to look at Heiken Ashi whenever we look at trend identification. Now, I think I'm not sure the audience here are familiar with looking at when you trade CPO. There's also what we call spread, or rather the term for it is calendar spread, whereby you're buying one particular month and selling another month, and vice versa. Now, a lot of people will say, "Oh, spread is very difficult. It's confusing." But just take away the fear. If you really go, and read a bit more details on it, it's actually quite a easy term, or rather easy strategy to navigate. Obviously, trading spread involves lesser risk. And in fact, if you are someone new to spread trading, you can actually look at spread chart and apply the same technical basis as you can apply for FCPO or FKLI for a matter of fact. So what I have here is basically to look at the spread chart. And again, you can also apply Heiken Ashi into it, and you can clearly see that whenever the the spread turns a bit more bearish, is very evident by the red color Heiken Ashi bars. So you can actually apply technical tools on spread as well if you are looking into spread trading. Now, so there's it's not fair for only to say all the good things about using Heiken Ashi. It's also I need to be fair in the sense that to point out what are the disadvantages of using Heiken Ashi. Now, because of the calculation, the nature of the calculation of using Heiken Ashi, in a sense that sometimes you do not see the, or rather the closing price that you see on a Heiken Ashi bar is normally the wrong price. So what you should be doing is that if you want to get the actual data of the open, high, low, and close, normally it's best for you to use a normal Japanese candlestick, because whatever data that you see on a Heiken Ashi bar, especially the closing price, is always different compared to a Japanese candlestick, because Japanese candlesticks take into account your gaps, which Heiken Ashi does not reflect the gaps. So in a way that is actually showing you a different price. In a way, you can get a bit confusing, and that's where the danger comes in. But if you just use it for trend identification, I think that's safe enough. But you really need to acknowledge that is the disadvantage part of using Heiken Ashi. Obviously, if you're looking into open and close prices, those figures or those prices may not be right and may not be accurate. So the alternative is always, if you want those information, go back to Japanese candlesticks. I think second, the main disadvantage is always there's no gap. When you look at Heiken Ashi, you don't see the kind of gap. So if you are someone that's trading on gaps, breakup gaps or opening gaps and whatnot, I think Heiken Ashi is not suitable in that sense. Now, just to show you, I think this is basically Japan's candlesticks to highlight to you the closing price, on the Japan's candlesticks. And if you see it on a Heiken Ashi, it shows you a different price. So if you're comfortable with that, then fair enough, you should be comfortable using Heiken Ashi. But if you are just looking purely on the closing prices, I think it's always better for you to refer back to or changing back your chart layout back to Japanese candlestick, because that's where you get a more accurate reflection in terms of your prices. Now, again, I think whatever you apply in candlesticks, you can also apply the same in Heiken Ashi. You can also identify chart pattern. So here you can clearly see it seems like it's forming a head and shoulder pattern. So again, you just draw a neckline, you break below the neckline, that tells you generally the pattern is going to hit on a possible downside. So that's why I mean it's not only good for trend identification. It can also apply the same chart pattern analysis as what you apply for your Japanese candlesticks. Now, I think Heiken Ashi itself may not be only good enough. It's always good to incorporate other type of strategy. I think what I always do is to not only use Heiken Ashi, but to also put into moving averages. And moving averages, there's so many types. I think one of the common one that people always use is the simple moving average. And I think that's generally what people use. But if there's so many types of moving averages outside and it's available on most charting platform, the one I always use is always exponential, in a sense that exponential reflects a bit more, or rather it reflects the nearest data more accurately. So in a way that you reflect prices much faster as compared to simple moving average. So I'm just not going to go too much on explaining much moving averages, but really I think applying it. So if you can see, I think comparing between using simple moving average and exponential moving average, you notice that EMA does give you a bit more precise, and it does reflect prices a bit faster compared to simple moving average. So in a sense that it gives you a signal slightly faster. So when it comes to moving averages, I use crossover strategy, which means that you always pair two different type of periods in moving averages. One, we call it a shorter period, and one is the longer term period. The shorter term period could range from what I use here is 9 period EMA. The longer term is 20 period EMA. So that's, if you use it on a daily basis, that's pretty much about 2 weeks and a month worth of trading data. So I think that's quite good in terms of indicating to you whether the market is going to turn uptrend or downtrend. Now, if you incorporate this together with Heiken Ashi, it gives you quite a good signal in a sense that, if you see a green Heiken Ashi bar, and if you see a bullish EMA crossover, which means that the shorter term crossing above the longer term, and if you see a green Heiken Ashi, that generally tells you it's a good time for you to be entering the market because the market is going to turn upwards. And vice versa, if you start to see red color Heiken Ashi together with a bearish crossover on an EMA, which means the shorter term crossing below, that tells you generally it's going to be a downtrend market. So I think here is another perfect classic example. You can clearly see this is on the palm oil chart, and it's based on 15 minutes. You can clearly see there's a bearish crossover on EMAs, and there is also red color Heiken Ashi bars. So once these signals appear, I think that usually point you that the market is heading on a possible downtrend. Now, EMA is also very useful on its own, but I think it's good to combine with Heiken Ashi because it gives you that kind of signal in a very clear manner. So here you can clearly see whenever there's a bearish crossover, and with Heiken Ashi bars, that generally tells you it's going to be on a downtrend. Again, you have another classic example here. This is on your FCPO chart. What you have here is that you start to see a bullish crossover where your shorter term are crossing above the longer term, and you have a green Heiken Ashi candle, which tells you generally it's a very strong uptrend coming up. Now, this is again, I think I do want to touch on spread charting because spread is something that is also commonly people tend not to touch because it tend to get a bit more complicated. But what I want to emphasize is that actually you can use technical charting on spread market as well. So again, you have a very good example here. This is basically the January-February calendar spread. There's a very good opportunity for a sell position here, whereby you can start to see a red Heiken Ashi together with a bearish crossover on your EMAs. That's a very good signal for you to be shorting this particular spread. So I think I want to incorporate another indicator. I know it tends to get a bit messy. Normally, when it comes to trading, it's good to always keep it simple. But I think it's worth to mention this particular indicator called ADX. And I think it's developed by Wells Welder. The reason I want to mention this is because we are talking about trend, and I think this indicator is very good in terms of gauging the strength of the trend. And besides looking at Heiken Ashi, if you have another company indicator that helps you to guide you, especially during the market, I think it helps a lot. So I'm not going to go too much on the derivation of how we derive, this particular ADX indicator, but I want to focus more on looking into interpreting it. So again, I'm just going to, all this will be shared with the audience. Hopefully the slide deck will be shared with the audience. You can always have a look at it, but just look at the chart. Now, I believe ADX indicators are widely available in most charting platform. Now, if you look at this particular chart I have here, so we have a Heiken Ashi candle, and the bottom panel is basically your we call it your ADX line. So technically, there's three types of line. Normally, the blue line is what we call a DI positive. The red line will be your DI negative. So that means DI negative, the price change is negative. DI positive, that means the price change is positive. Now, if you notice that there's a couple of signals you can gather from here. Whenever the blue line crosses the red line, positive crosses negative, that usually a signal for you to go long. Now, there's also another third line, which is the black line. That is what we call the ADX line, and this is equally very important. So ADX line tells you, basically it tells you whether the strength, whether the strength of the trend is in place or whether the trend is weakening. So as long as the black line is rising, that tells you generally the market is going to go higher. If it's an uptrend, it's going to go higher. Now, if the black line is coming down, especially during an uptrend, that tells you, the uptrend, it has lost its momentum, and that you should be a point. If you're having long position in the market, you should be exiting. So just to show you a classic example, here what we have is that we have the blue line crossing above the red line. So that generally tells you the market is going to go on an uptrend, and the black line starts to go higher. So once you see that, that tells you generally the market is heading upwards. And true enough, you look at Heiken Ashi, the candles that is forming is also green colored Heiken Ashi. So that tells you, the uptrend is pretty much, the momentum is still intact. Now, obviously, you can continue until, where the blue line starts to cut below the red line. That tells you generally the market is going on a downtrend. Now, what I want to focus is more on the black line because that tells you the strength of the trend. So if you see an uptrend, the black line continue goes higher, which is what we call an ADX line. That means it's really quite a healthy trend, and the trend can still continue. We should be taking more precaution, especially when the black line starts to go weaker or starts to come down, especially during an uptrend or a downtrend, because that tells you generally the market trend is going to get weaker. So if you are having positions in the market, if you see the ADX line starts to drop, that's where you should be thinking whether it's good time for you to be exiting the market. Now, so that's on ADX. The reason I want to put ADX is because it's also part of the trend identification. Sometimes I use that because if let's say I notice the market is actually changing trend, I want to identify whether the particular trend has strength or not. And I think ADX itself gives a very good indication. Now, I think the last bit of the trading plan is always talking about risk management. And I think one great tool for you to manage risk is always to look at true range. It's basically you can have this ATR tool that is available on most charting platform. Now, average true range basically to measure the daily range. And in a way, it's true range because it takes the previous close. So in a way, it count gaps. When you mention about range, it's just not only high minus low, but it's also again comparing with yesterday's close. So in a sense that it actually present to you the actual fact or the true range of the market. Now, obviously, if you look at this chart here, the bottom panel is your what we call the average true range value. And basically, once this value goes up, basically the range of per day basis actually goes higher. And that's where, if you want to manage your risk based on ATR value, you have to prepare to, put a higher buffer because the volatility of the market has actually increased. So that's the function of ATR as a risk management. So a lot of people use ATR values as a way to manage risk. So for example, if the daily ATR is 200 points on a CPO market, the daily ATR value, and let's say you found a short opportunity in the market, let's say you short at 4,000 ringgit, you should be putting a stop loss at 200 ringgit above, just to make sure that, in case you get stopped out, you stop out at 200 ringgit above, which is one-time ATR. Again, the multiples of ATR is up to individual, and it's all depend on how comfortable you are with your risk. Now, so this is classic example. Once you see there's a good opportunity for you to taking a short position here because of the red Heiken Ashi and the bearish crossover on EMA, we can actually use the ATR value to make sure that that will be the point where it's good for you to put your stop loss. So the higher the ATR value, technically you're putting a higher stop loss because the range of the market is actually increased. The reason we want to accommodate ATR value is because we don't want to get stopped out too frequently. If you there's a lot of ways to fix your stop loss, whether you can be a fixed mental stop. Let's say I want to lose 10 points, 20 points, or what? How many points you want to afford to lose on a single day? That is actually, first thing is mentally very tiring. Second thing, actually you tend to get a lot of whipsaws in the market and you get stopped out very frequently. So a way to counter that is to try to use the ATR value. But using that, one thing you take note is that when market starts to get very volatile, as well as seen lately in recent times, that's where you need to adjust your ATR value, accordingly. And that's where, some people may not be comfortable. So again, you need to weigh your basis. So now these are all ways for you to track, ultimately at the end of every trading strategy or trading decisions or trading plan that you have in place, it's good to make sure that you have something to measure your strategy, whether your particular strategy does make sense or not. So there's a lot of ways to measure. I think one thing is to make sure the net profit itself, you compare all your trading execution have done, whether are you net positive or net negative, as simple as that. Obviously everyone is striving to have strategies that ensuring them that overall still be positive. Now, this profit factor, we're just basically looking at your gross profit to gross loss. Now, these are all numeric calculations. You can obviously have it as part of a matrix. Percentage of winning trades is basically out of 10 trades that you have been doing, how many of those trades are actually making money. Sharp ratios are a bit more complicated. There's a couple of formulas in it. So I'm not going to go too much on it. You can obviously get this on the internet. And maximum average excursion is basically looking at equity. Now, all this seems to be very, if you're first time hearing it, don't get scared. I think all these are basically metrics of, gauging your performance. Now, at the end of the day, you need something, a matrix for you to compare. And the one thing I think, being trading in the market, for a period of time is, one thing we really realize is that you need to have data about yourself. The more data you have in terms of a performance basis, the more you can evaluate your particular strategy, whether this particular strategy is helpful for you or not. If it doesn't, I think it's actually time for you to look at a different set of strategy that you can employ. And that's why, having data is important for you to, really gauge where, or how efficient it is your strategy that you're using right now. So these are basically a contract specification. Again, I think all this, I mean, you can get it on the Bursa website. All this information is available on that website. Now, this time I mentioned talking a little bit on spread. The reason I did mention that is because if you just look at the listed contract that is on the exchange, you have a lot of different combinations that you can do when it comes to spread. So in a sense that you have a bit more variety. And like I mentioned earlier, technically you can also use spread. You can apply technical tools on spread, calendar spread as well. So not necessarily, just looking at 2 different months. Oh, you must understand a little bit more in that. No, you can use it in a more simple way. Just pull out the charts. Look at where the Heiken Ashi candles is. Apply a exponential moving average and see where the market is heading. You can even make decisions on that. So I think it's good if you are, you are exploring the market. Spread, calendar spread trading could be something that you can look at it as well along the way. So coming to the end, I always emphasize this: trading with a trend is always a good business to be in, easier business to be in. Trading against a trend is very difficult in the sense that, trying to time a particular peak and bottom of the market is usually very difficult. Now, I think I mentioned about using ADX as a tool for you to look at the strength of the trend. I think that's something that you can use it, especially when you are looking at whether the trend is going to stay or not, or it's going to get weaker. I should be out of market. ADX is give you a very good indication. Moving averages, if you apply that with Heiken Ashi, I think it's a very good combination. Obviously, if you can experiment yourself, take this derivatives trading challenge as a way for you to look at different other sets of strategy that you can employ when you're looking at the market. But always make sure that whichever plan you come up with, at the end of the day, you must have a stop loss management in place. I've shared with you using ATR as a tool for you to manage your stop loss. It may not be perfect, but at least use that as a gauge for you to exit the market when you hit your ATR value. Last but not least, regardless whatever strategy, at the end of the day, always measure yourself by your performance matrix. And traders always say this, it takes a lot of discipline, it takes a lot of hard work, and it actually goes down to the process that you actually go through every day on a daily basis. So I think tracking your progress, whether it's putting up a journal, looking into your performance sheet, I think that's all equally important to the journey of a successful trader. So with that, I'm just going to end here. I'm going to pass it to Ting Ting.
Okay, thank you very much for David for your presentation. Now, I believe by now you should be able to differentiate what is Japanese candlestick and also Heiken Ashi. And you can also incorporate other strategies like your ADX, your MA, and also your ATR into your Heiken Ashi. Now, before we are going to go into the Q&A session, you can start to ask the question in the Q&A box. Later, we are going to pick up the question and refer to David. Before that, please allow me to introduce our second speaker for today, Mr. Eric. He has more than 5 years of futures industry experience as a futures broker's representative, and he's currently a manager in futures business development team with RHB Investment Bank. So I'm going to pass it over to you, Eric.
Services, starting with equities and futures trading, to share margin financing, discretionary financing, financing for IPO and employee share option scheme, wealth management products, and of course, Islamic broking. Now, RHB Investment Bank has offered futures products from 6 established exchanges all across the globe, starting with our friends over at Bursa Malaysia Derivatives. We have CME Group, Hong Kong Exchange, Singapore Exchange, Intercontinental Exchange, and as well as Tokyo Commodity Exchange. These are the top 10 most popular foreign futures products in recent times. And RHB Investment Bank is also grateful that we are able to offer a total of 66 derivatives products to all of our clients, most of them being futures products, ranging from agriculture to metals, indices, and many more. In case you're wondering, the products that are highlighted are by request only, so no worries. Just drop us a simple request if you're interested. So over at RHB, we offer three futures trading platforms that are suited for all your needs. Starting with ASGTS, which are recommended for the new traders, QST, which are the more suited for high volume traders, and of course CQG for the more experienced traders. As you can see from the screen, all 3 of the platforms are available on mobile application, so it is more convenient for most people. So no worries on that. And also, we are excited to share with you that currently we have a futures campaign ongoing. So wait no further and open a futures account with us and trade at least 10 lots to be eligible for 50 ringgit of Touch and Go e-wallet reload PIN, as well as for all new and existing customers. Just trade with us and stand a chance to be one of the 50 lucky draw winners with a total prize pool of 30,000 ringgit. Now, you could, if you're interested, you could please scan this QR code on the screen to find out more on the campaign, as well as if you're interested to find out on the TNC as well as the FAQs of the campaign. Now, as for DVTC, this time around it will be the second DVTC organized by BMD, and we are sure that it will definitely be an exciting one with a bigger prize pool than the previous year. This time around, the DVTC will include 2 categories, one for individual and one for the university team. So sign up now, and the challenge period actually runs for 1 month, starting from 7 November all the way to 6 December. And one thing to note that is every eligible participant may only participate in one of the category above. So please choose wisely whether you are an individual or the university team. And until then, actually you have until the 20th of October, which is also just next Friday, to familiarize yourself with the trading system and to test out some of those trading strategies that you may be interested to try. In fact, actually we have two webinar sessions, one in English and one in Bahasa Malaysia, which are conducted by our dear colleagues Korting En and Anwar Hashim. If you are interested to find out more about the in and outs of the DTS system used for the trading challenge, do scan the QR code for more info, which will be conducted by Korting En on the 25th of October. And as for the Bahasa Malaysia session, please scan the QR code as you can see from the screen to find out find out more on the trading system that's conducted by Anwar Hashim, as you can see from the screen over there. So do sign up, as it will definitely be an informative session. Now, wait no further and register already for DBTC. So everyone, you get to start off with 100,000 of virtual capital currency, and with that you can trade your way all the way to the highest account balance by the end of the campaign period. And yeah, just give it a try. It will definitely be very interesting. And these are the 5 products that will be available during the challenge, including the revamped gold futures, and last but not least, of course, crude palm oil futures. This session should be beneficial for everyone actually, starting from beginners all the way to experienced traders, as everyone will be trading on real-time trading, and you could actually test out all of the trading strategies that you've been itching to try. So sharpen your trading and analytical skills, and in fact, you could even test out the interesting Heiken Ashi that was shared by Mr. David Ng, and learn to identify market trend during the challenge. And these are the prizes that will be offered during the DBTC challenge. It will all be cash prizes. It'll be a total of 15 prizes in each bracket, and it comes up to a total of 40,000 ringgit in a total prize pool. All you have to do is just trade at least 20 lots during the challenge, and you will be eligible for the contest. So thank you everyone. If you're interested to open an account, please scan the QR code as you can see from the screen. Or if you have any queries, do drop us an email as you can see from the screen, or via a phone call that is available on the screen as well. So without further ado, I hope everyone managed to sign up for this challenge. Good luck everyone, happy trading, and thank you.